Welcome, everyone. This is the April webinar from Principal Wealth. I'm Julina Ogilvie, partner and wealth advisor, and joined by Bob Paolucci, our founder and CEO. And Bob, I'm going to kick this off by first saying we are doing this a day earlier than we normally do because of what's going on with the markets, and we wanted to address it as quickly as possible. And when you and I jumped on this Zoom to prepare a little while ago, I asked you how you were doing, and what did you say?
Fantastic. This
Love
is
it.
our Super Bowl. We are made for these environments. We are fearful when things are calm. We are very excited when things aren't.
Mhm.
And that is, very, I think, very unique to us in this firm. We like to take advantage of inefficiencies. We like to take advantage of scenarios where um, markets may be reacting in a way that is irrational.
Hmm.
Um, we like to take advantage of scenarios where uh, we can get high quality stuff on sale because the benefits for the future are so robust. So um, we know what uh, uh, great opportunity periods look like and smell like and feel like, and this we are approaching one of them here. I
Hmm.
should also pause and tell you and remind you that these levels are what we predicted in January.
Yes.
Um, when you say something like this in a bull market, or when you say something like, hey, we think the market's due for a pullback, we actually think we're in the midst of one. I know it doesn't feel like it. Certainly didn't feel like it in January to most. It felt like it to us,
Hmm.
that the winds of change were blowing in. Um, uh, it's almost like people didn't appreciate what we were
Yeah.
saying then.
Until you
Uh,
feel it.
they appreciate it now until you feel it, right? Until it's real,
Yes.
right? Like there's a
Absolutely.
storm coming, but it's beautiful outside. Okay. Then the storm comes, and then there's, oh, now I understand.
Yes.
Yes, this is what we were talking about. The storm was coming. Does that mean we wanted to sell high quality securities just because they're down a little bit from their all time highs?
Mhm.
Absolutely not. But it does mean if they do come down from their all time highs, we want to buy more,
Yeah.
especially the good stuff. Um, so we saw this coming to a degree. How it arrives really doesn't matter to us. It's
Yeah.
the fact that it arrives, and we have a plan and strategy to take advantage of it.
Yes. We're
Uh,
gonna we're gonna
yeah,
certainly share that, right?
we're
And
going to share that. Yeah, I want to also articulate to our clients, um, nobody is calling us. I shouldn't say that. I believe cumulatively amongst the firm advisors, the calling in about all of this, keep in mind we work with hundreds of people.
Mhm.
Um, we manage a few $1 billion for hundreds of families and hundreds of people. We have received less than 20 phone calls
Mhm.
about this stuff over the past 30 days.
Mhm.
So it's funny when we do meet with and talk to our clients, proactively. Everyone says, and our clients are so wonderful. Everyone says, "How are you doing?"
Yes.
It's like they feel bad for us.
Hmm.
They're so thoughtful. We're
Yes.
fine. We're again we have the opposite um, emotional set
Yeah.
that you might think going on right now, and it is really us preparing for the execution of and taking advantage of the situation that is finding its way into the markets right now. So thank you. Yeah, we're not getting a lot of nervous clients. Why? Because we educate, articulate things to them, because we explain things to them. We try to always tell you what and why we're doing what we're doing,
Hmm.
how it relates to your financial plan, your net worth, what small short-term changes do in the long run. Not much. It's if there's anything that negatively impacts clients that sticks, it is bad behavior.
Hmm.
It is
Yeah.
bad behavior. It is emotion that turns into the opposite action that we would like to see. Again, but that rarely happens.
Hmm.
And again, it's understanding the markets, and hopefully we're teaching people and educating people about it, and being okay with the asset allocation that you have. That really matters. So
Yeah.
thank you for thinking of us. We're thinking about you. That's why we're reaching out to you. We truly appreciate it. We're not worried. Uh, we have a plan. I can tell you,
Well,
when we are worried, you
yeah,
should definitely worry, and we'll send you a golden ticket that allows you to worry. But we are not worried here,
yeah,
um, and it's because we are trained professionals. We are highly skilled. We have been to the rodeo many times, and we know how to lasso it and take advantage of it. And this one is not going to trip us up. We'll be able to do it here as well. So.
yeah. And I think to that note, that's the reason we titled this webinar Wonder Over Worry.
Yeah, and again, the meaning behind that really is it's something that I said yesterday in a team meeting, and I think it makes a lot of sense. It's okay for you to wonder,
Mhm.
and we want you to wonder. We want you to be curious, but we want you to live in that zone
Yeah.
versus not communicating with you. And if you're fed too much media and
Mhm.
too many headlines and too many of your friends that think the same way, you're going to go from wonder to worry. Right? Stay in the wonder zone. Don't enter the worry zone, and we're trying to do our best to again articulate to you what we
Yes.
see, why, what we're doing to take advantage of the scenario or to prepare for the scenario, so on and so forth.
Yeah.
So stay in the wonder zone. We don't want you to worry. Focus on that. It's okay to be curious, and if your curiosity and wonder turns into worry, go for a walk. um, go out to eat, go do something else. When it comes to the markets and all that fun stuff, that's why you're working with us.
Mhm.
We're going to do our job. We're going to do it well. That's our fiduciary duty to you. One of many things is portfolio management that we do, and we do it quite well, I think, as you know that, and we
Yeah.
will continue to do so for you.
I think it's also important to know that we're not worried and that you said this in the webinar last month. We will worry at some point and we will let people know. And that is not the case here.
Yeah,
And
when we worry, we act
yeah,
first, and then we will let you know.
yeah.
In that
Fair
order.
point.
Yeah, in that order.
Yeah. So, and I think to keep the cadence of what we've been addressing in past webinars, we are going to talk about the markets, economy, and policy, and everything else. But we want to start with this sort of general discussion as well, and it's important to know what our mindset is right now.
Yeah,
So,
and I'm just going to read something to our clients. This is an email that I typed to our staff. Some of the parts I can share, some of the parts I can't. But around tariffs, um, we
you're
from
jumping
the
right into it.
yeah, we're going to go right into it, and again, we'll address it in another slide. But
Yep.
it's probably top of mind for everybody. Um,
Absolutely.
so the tariff plan, and I'm using plan lightly here, is was initially discussed as a way to sort of offset the tariffs that other countries have on us, right? It's sort of to get to a
Level.
real free trade level playing field, right? And look, over time, I feel like that could happen, right? But whenever you are trying to pivot and plan long term, right, you need time
Mhm.
to execute that plan, right? There, both sides have to have infrastructure set up, accounting, a strategic plan,
Mhm.
right? Things in place to allow both sides to adjust to
Right.
that new zone, right?
Mhm.
That's common sense. So when you start to hear things that defy common sense, like we're going to do this, you need to do it now, so on and so forth, it, the strategy goes from a plan, a strategy to a tactic, a tool, right? And we very early on had a hunch that it was a negotiating tool and tactic. And now we firmly believe it is only a negotiating tool and tactic,
Yeah.
because when you read through the plan, the tariff plan, you will quickly see that it is very hard to execute, right?
Yes.
I don't want to say impossible, but I'm feeling it's very close to impossible. It's hard to record keep. It's hard to enforce. It's
Yeah.
hard to document. It is hard to execute.
Yeah.
And, you then say, well, are those numbers real? Well, let me first start by saying the tariff rates were calculated not off of tariff rates. They were calculated off of the amount of deficits with various countries expressed as a percentage.
Correct.
So just call it, that's a tariff. If it feels like, looks like, and can quantify it like it's a tariff, that's what it is, right? It's not.
Hmm.
It is the size of the trade deficit with a country. Our response as an actual tariff is it'll be 50% of that,
Hmm. Yeah.
right?
Yeah.
Okay, number
And
one. So it's deceiving, number one. Number two, after you understand that, you say, okay, are there any exceptions or exemptions? It might just be easier, Julina, to say what is subject to these tariffs, right? Because
hmm.
when you read through how it's written, it says things like anything under the USMCA, which is the US Mexico Canada Agreement that
Right.
was put into play in 2020, is exempt. Okay. What else? Well, unless you're China, it is not duplicative. What does that mean? Well, China has this 20% penalty that we assessed, plus an additional 34%,
Hmm.
right? Not to be confused with other countries. We are not applying the same treatment to you.
Right.
So then is this really only about China? Seeing that we have the biggest trade deficit with them? We think so. More to
Hmm.
come on that.
Yeah.
Um, this won't be stacked on top of existing duties by sector, vague language. Um, there is a 10% flat tariff on 60 countries, more on about 120
Hmm.
countries. Again, I'm just reading you some of the cliff notes here.
Yeah.
Um, the new tariffs won't add on tariffs previously announced on steel, aluminum, and cars. Amazing.
Hmm.
Um, here's the other stuff. Some goods will not be subject to the reciprocal tariff. These include articles subject to Article 50 USC 1702B, steel, aluminum articles as they relate to autos, copper, pharmaceuticals, semiconductors, and lumber. Um, any articles that may be subject to future Section 232 tariffs. This is amazing. Bullion and energy and other certain materials that are not available in the United States. Wow. So again, the market hates the confusion of it.
Exactly.
It doesn't dislike it. It hates the confusion of
Hmm.
it. Okay.
Yes.
And I would say to that, right, this isn't a bill or a plan. This is a negotiating tool and tactic. And if it were a actual bill or plan and something that you can easily record keep and execute upon, we'll start it now.
Right.
Don't give the world 7 days before it's effective.
Hmm.
The 7 day period is let's negotiate so I don't have to do this. You have to understand that.
And it's already
Now,
begun.
it's already begun. So, yeah. So, maybe some of the clients know this, but literally yesterday, after uh, the White House went to the print shop to create these charts of tariffs, right,
Hmm.
that I think everyone has seen, um, India, Mexico, and Canada caved,
Hmm.
right? But the charts were already printed, so they didn't want to edit them. But ultimately, Canada, who has been very vocal about fighting back, uh, completely pivoted and said, "Okay, we won't tariff you anymore. You don't tariff us."
Hmm.
Number one. Number two, Mexico is right behind them, not with the exact same language, but they pretty much said, "Fine, we're okay with the tariffs. Just don't do any more,
Yeah.
and we won't retaliate." I mean, literally, this is what they said. We could Google it. You'll see if you don't believe us. India said something along the same line. So you could see that the dominoes are starting to fall.
Very
Right.
quickly.
Yeah. What a rough and gruff way to negotiate. But
Yeah.
look, other forms of negotiation over the years and decades haven't been.
Yeah.
I'm not making any comment about it, but maybe they haven't been as effective.
Hmm.
I don't want to say this is the new way that we should be negotiating or articulating our displeasure in, trade balances, but I mean, it certainly is creating some change,
Hmm.
upsetting a lot of people along the way. But again, I think these countries will get over it. Now, whether they all cave, we're going to see. But so far,
Yeah.
it does have some countries and leaders coming to the table. So
Yeah.
I just wanted you to be aware of that. Again, we view it as a negotiating tool. We think this is not meant to be enforced. We think it's temporary. And especially when you read through the nonsense of what is excluded,
Yeah.
um, you know,
It-
in essence, anything that will benefit the United States. And we get to pick and choose and we get to change our mind. And if we don't have these materials, that will be exempt.
yeah.
If we do, but we want more, that will be exempt. And what's that?
Yeah.
What's that? So again, a great scenario where it creates capital markets inefficiencies,
Hmm.
right?
Yeah. No, I thank you for going through all that because it's clearly top of mind. And I know we have some great slides that we're going to go through in the presentation to kind of reiterate maybe some of the points that you just made that are extremely important. Let's transition maybe to the markets
Mm-hmm.
and what's been going on there because we've had a lot of client reviews, and I think a lot of clients have been surprised about the conversations we're having around this.
Yeah, a portion of the market is down.
Hmm.
Not everything within the market is down. Expressed as a whole, yes, the
Yeah.
stock market and certainly pieces of the stock market are down. Certainly the biggest companies who have been up the most, mind you, are
Right.
down a little bit from the massive run up that they've had,
Yeah.
right? No one
Yeah.
likes to take a step back, but in the grand scheme of things, when you make 20, 30, 40, 50, 60, 70% over the past couple of years,
Hmm.
pulling back a little is completely normal. And I can argue that it's healthy.
Yes.
Without little pullbacks and a breather in the market, it's very hard to go higher. Um, Markets ride these tight rails of where they've been, and that's both up and down. And sometimes they just kind of retrace those trends and then
Hmm.
they head higher, right?
Yeah.
So then the band keeps going higher.
Yes.
So ultimately, I'm sure clients feel like if they're not looking at that portfolio, if they're just listening to the news, that the market's down 50%. It's not. Um, the S&P through yesterday, right? Today's a bad day, but through yesterday was down for the year
Hmm.
4%.
4%.
I mean, and that's rounded up, so it was in the threes.
Hmm.
After today, it'll probably be down um, uh, for the year, probably 8%.
Hmm.
Now, from its high, remember the market went up in January and the first half of February, and then
Hmm.
started to go down, peaked mid-February, started to go down then. Yeah, there's a peak to trough drawdown of the S&P
Hmm.
of right now, I believe it's 11 or 12% or so.
Hmm.
So that is in correction zone. Now, that is
Yes.
not the end of a bull market. That's just I hate to
Which are
say it.
common.
I don't want to, I don't want to minimize it, but that is your normal drawdown.
Exactly.
Technically, if you go back over time, a normal drawdown is 14% peak to trough. And, we believe we'll get there, which
Hmm.
means there's a little bit more pain from here, which is why we're starting to get excited because those are the key intervals and key levels that we like to invest money
Yes.
around.
E-
But
Exactly.
it is not what you think. This chart shows you. How about this? I mean, as of yesterday, the Dow, which is just made up a little differently, was down 1%.
Yeah.
It's obviously down more today. But these are from all-time highs, not just recent highs. These are all-time highs.
Hmm.
So it's going to be okay. You do have a scenario where the Nasdaq is down more. Why? Well, the Nasdaq and the average stock in the Nasdaq have done well above average,
Hmm.
um, for quite some time. Certainly the past few years. But Nasdaq is really the home of technology, and it is the technology sector in the stocks that live within that sector, generally speaking, that are getting punched up a little bit,
Hmm.
right?
Yeah.
So it is the largest seven stocks, the Mag 7, as they call them, that are pulling back the most. Why does that matter? Well, because of the weight that they have in the markets,
Hmm.
right? You're going to be fascinated to learn when we get into some of these details that um, outside of the Magnificent Seven, which is a little bit less magnificent right now,
Hmm.
um, that index, X Mag 7, is doing completely fine.
Yeah.
It was actually positive as of yesterday for the
Yeah.
year.
And I think just to really quickly point out the Magnificent Seven here, right? You can see the visual of how they got beaten up.
Yeah, look, we have this cute title, the Less Than Magnificent Seven. But
Correct.
on the left side, you see the full year for 2024. Yeah, I mean, Nvidia went up 171%, Tesla went up 63%, Alphabet, which is Google, went up 36, Amazon 44, Apple 30, Microsoft 12. They were all close to the top of the S&P 500, which is great. And they do live in that zone very often.
Hmm.
On the right side, you see year to date, again, through yesterday, Tesla has a 30% pullback. You could see their ranking in the S&P is at the very bottom or
Absolutely.
very near the bottom.
Hmm.
They have had big pullbacks. They had big run-ups. They had big pullbacks. That is what you get with some of these stocks, right?
Exactly.
It is completely normal. It just, it's never pleasant, but it is what it is. Now, thankfully, clients have diversified portfolios. These aren't the only stocks that clients own in portfolios, whether it be direct or indirect through wrapped products like an ETF or an index fund or something like that. So,
Exactly.
again, just the articulation of it. Here's a chart illustrating what I just said. The red line is the S&P 500 minus the Mag 7. This
Yeah.
is through the end of the month. It
Just
was
below that zero line.
yeah, I mean, it was again, it was flat for the year. Then you
Yeah.
have the S&P glued together as a whole, which is blue. And again, it's not nearly as bad as you think. And then there's the Mag 7, which is
Hmm.
as bad as you think. It's those seven stocks
Right.
grouped together. Yeah, if you marry them together, right now they're down about 20%
Yeah.
for the year, but also they're down probably about 24% from the high,
Yes.
right?
Exactly.
But hey, if you want to make a lot of money, you have to invest in you have to take risk,
Yes.
right? you,
Yeah.
you have to be able to tolerate volatility. So if you want to make a lot more money over time, you buy high quality stocks and you overweight high quality stocks and you hold them for a long period of time.
Mhm.
And what's the reward? Well, the reward for tolerating that volatility is outsized returns,
Absolutely. Yeah.
right? Easier said than done, though.
Hmm.
6 months ago, I bet we could have convinced everyone to take maximum risk. Why?
Hmm.
Because it was a good feeling. And it's like, yeah, we can prove it.
Yeah.
And then they're convinced that they want to buy speculative stuff, so
Hmm.
on and so forth. And then a little ounce of volatility comes in
Yes. And it
and
changes.
nobody wants to do it. Yeah,
Right.
that's why we don't do it.
Yeah.
So that's why we have diversified portfolios. You have value stocks, you have dividend paying stocks, you have some growth stocks, so on and so forth.
Yeah.
This sell off is hyper focused on very few sectors. I can even argue that the sector wrapper is nonsense. When
Hmm.
you look within the sectors, you'll see here that it's infotech, which is the technology sector.
Yeah.
What you're looking at is a chart of the 11 sectors of the stock market. Okay. Seven of them are positive.
Are positive. Yeah.
Seven of them are positive.
Yeah.
How about that? Number one. Number two, the three sectors that are negative on the right hand side are communication services. The two biggest companies in communication services are tech companies.
Hmm.
I think they're mislabeled. Meta, which is Facebook,
Hmm.
and Google.
Yeah.
Okay. Um, Technology sector, common sense. It's tech companies.
Hmm.
Consumer discretionary, not common sense. Consumer discretionary are, tech company heavy. Tesla,
Hmm.
Amazon.
It's on.
Yeah. So if the S&P 500 did a better job of labeling these companies
Hmm.
based on what they really are,
Yeah.
you would take the two big companies from communication services, put them in tech. You would take the two big companies from consumer discretionary, put them in tech. This is a technology sell-off.
Right.
Clearly, you could see it
Which
right
we'll
before
show
your
another
eyes.
slide in a moment of that, but it's also interesting to see if you zoom out, right, and look over the last 5 years.
Zoom out.
Yeah.
Um, the S&P 500 and all of its parts is up 128.5% over the past 5 years. This is 5 year cumulative performance. So is a 11% pullback, or if it gets to 15, I hope it does, so we can actually execute more orders to buy good, high quality securities for clients at a discount that they'll
Right.
benefit from long term.
Yeah.
Um, is a 15% pullback after 128.5% cumulative return over the past 5 years a big deal? Is the NASDAQ pulling back, let's say it gets to 25%, which
Right.
again, the NASDAQ is different. It marches to its own beat. It's very focused on growthier things in
Hmm.
technology. I don't know, a pullback from 152%, let's say the cumulative number is recasted at 125%.
Yeah.
That is still phenomenal.
Absolutely.
And then you compare small caps over the same 5 year period haven't had the run up, which is why we think there's opportunity.
Correct.
Um, and international stocks have not even kept up with small caps.
No.
And we still don't think there's much opportunity there.
Yeah.
There likely will be
At
uh,
some point.
at some point.
Yep.
We just don't think that opportunity is now.
Yeah. And I also think it's important. I'm going to state the obvious here, but the 5-year return includes 2022, which was not a great year,
Oh yeah, I mean
right?
there's a
So,
recession, world shutdown
yeah.
scenario in here. There was a
Yeah.
2022 bear market that
Yes.
I think everyone has already forgotten about.
Exactly.
So these numbers are net of all that.
Yeah. Yeah. And
Yeah.
and we'll circle back on zooming out a little bit more later, but I think one last point too on kind of looking under the hood. You mentioned earlier, the difference the growth companies have really led over the last couple of years. It's being driven by the technology. When you look at the value companies, quality, dividend paying stocks, they were slightly positive when we ran this return for the year.
Yeah, to keep it very simple, right? We're showing three things here. We're showing not only the S&P 500, we're showing the top 1,000. It's
Yes.
called
Oh,
the
thank
Russell.
you for saying that.
Yeah,
Yep.
the Russell 1000.
Yes.
It's the largest publicly traded companies in the U.S. stock market, weighted by market cap. Okay,
Hmm.
so it's the S&P 500 plus another 500. Just keep going on that sorting,
Yes.
and it is expressed through this orange line on the chart. But when you break out the orange line into two camps, two styles, you have value companies and you have growth companies.
Mm-hmm.
Growth companies, I'm just going to explain it in a super simple way. The traits that they have, they generate revenue, they spend a lot of it,
Hmm.
right? They don't have a ton of net earnings. In some cases, they do, but growth companies are rapidly expanding, spending a lot on R&D. They often don't pay big dividends.
Hmm.
If they do anything, if they have free cash flow, they oftentimes buy back a lot of their stock, right? A
Hmm.
lot of the tech companies, a lot of the biotech companies fall into that growth space. There are even some industrials that fall into that growth space.
Hmm.
Um, Value companies are known for their dividends, known for their more conservative nature, the Procter and Gambles of the world, and the Southern Company utilities of the world, and the American towers, the cell towers of the world, and some of the chemical companies, some of the sleepier companies,
Names.
right?
Yeah.
So our clients have a combination of value stocks and growth stocks, and you can see just as expressed through a factor
Yeah.
style, value stocks are doing great.
Yeah.
Glued together, the market is all not that bad.
Yeah.
It's growth stocks that are taking it on the chin. But
Yes.
remember, they are the performance leaders over time.
Hmm.
They
Exactly.
always run up more and pull back by more. That is what they are known for, and that is exactly what's happening here.
Right. So nothing surprising, of course. And it's nice also to see that bonds are behaving well.
I mean, for most of our clients, that other chunk in your portfolio, which is fixed income, is actually doing quite well. It's positive and might even be more positive now.
Yeah.
And they have very good yields that they're paying.
Hmm.
So, look, when we rebalance portfolios, we're looking at the ratio of bonds and cash relative to stocks. And I must tell you, it is always fun to sell an asset class that is rising to buy an asset class that is depressed.
Correct.
And when we think about rebalancing, sometimes we use cash. Sometimes we upgrade stocks from this type of stock to that type of stock when there's room to upgrade or an
Hmm.
opportunity to upgrade. Oftentimes, when we really, really are looking at allocations and think there's a real great opportunity, Um, you'll know we think it's a great opportunity when we start selling some of your bonds that are going up to try to take advantage of falling stock prices.
Correct.
We're
Yeah.
just about there. We're getting there.
Yeah.
And if you've seen orders and confirmations come in the mail or online via email, yeah, we're
Yeah.
getting really close to that. So
Eh,
we're getting to the levels that we thought we would see, and we're preparing to take advantage of it. So again, for clients that are diversified and they're not fully invested in stocks, and keep in mind, 80% of our clients have a diversified stock and bond ratio right around 60/40.
Yes.
That doesn't mean clients that are taking a lot more risk. It's bad. It's you've taken risk for a long time. That's who you are as an investor, and we'll continue to allocate that way. We will still also take advantage of this opportunity, usually from either utilizing cash or selling something that we
hmm
think will do well to buy something that we actually think will do better.
Yeah.
So just something to be mindful of.
Fundamentally, it makes a ton of sense. It's amazing to me that it's not done enough by investors and by advisors, candidly.
Yeah,
So,
yeah.
um, and let's talk a little bit about a new presidency and some of the weakness that it can bring into the markets.
uh, has a history of happening whenever there's a an administration change. What
Hmm.
that brings with it, and again, regardless of politics or persona or policy,
Yes.
whenever there's change brings with it a lack of clarity.
Hmm.
When do you get clarity? Well, when there is actual clarity around what the policies are, who the people are, what the goal is. It usually takes a quarter or two.
Hmm.
Historically, it usually only takes about a quarter. And what does that mean? Well, if you look at years where there is an administration change, of which this is one, the
Hmm.
first quarter historically of that year, of which we just exited, tends to be choppy.
Yeah.
Well, like clockwork, we just had a choppy one. That's the yellow. We
Hmm.
are now in Q2, right? So we are now in Q2, and Q2 tends to be the repricing of all of the uncertainty or much of it to say, all right, now we have some clearer data
Hmm.
points. We have a clearer strategy. Yeah. Are we there yet? Nope.
No.
Will we get there? Very likely.
Yeah.
Very likely.
Yeah.
So there's hope.
It,
There's hope.
if it feels like a roller coaster, it is.
It is.
But
We like pullbacks.
love it.
We like corrections.
Hmm.
We don't love bear markets. We like corrections. And the current correction that we have, again, this is a couple weeks old,
Hmm.
is that yellow bar on the right. The vast majority of corrections, which are pullbacks of um, less than 20%,
Correct.
they don't reach bear markets, which are greater than 20%. So the vast majority of pullbacks, and there's a ton of them, we're only just showing you ones between, in the green bar, 10 and 19.99999%.
Correct.
They they stay there, uh,
Hmm.
and they turn. We think this will be one of them. Where exactly? Again, we thought early in the year. Again, I'm on record saying it. 13, 15%.
Hmm.
I said something like greater than 10, maybe around 15 would be a healthy one. Yeah, that's likely where we'll get. We are not there yet. Where we are today, if you're curious, because this is a couple weeks old, the word didn't, it
Hmm.
would be right above the word didn't. That's
Yes.
roughly where we are, right? So not too far along from where we were. Keep in mind, this is just about the exact level that we were at on March 14th a few weeks ago.
Correct.
So we are back to those levels. Now, if you didn't see it, don't worry, most didn't, because it happened very quickly and then it disappeared, right? We went up from there. So we are now back down to that level, if that
It,
makes sense.
if I can also point out that one of the corrections on here is in 2018 when we addressed tariffs with his first administration.
Oh, that's a great point, Julina. The market behaved
Very similar.
very similar
Mhm.
when tariffs, which weren't covered as much.
Yeah,
The market had a little shaking going on as well. So sort of the same thing.
because it was uncertain.
That's
Yeah,
right.
absolutely. And this is one of my favorite all-time slides. I call it the measles slide, but you like to say, oh, the places you'll go.
Yeah, it's investing is a journey, and oh, the places you'll go. And again, this is through the lens of just investing in the S&P 500. It is much more volatile than you think, right? The golden child, the golden index of investing, that everyone refers to, that but nobody gets the return of because they can't tolerate the ride,
Yes.
right? Everyone tells you this is what you should invest in because it's free. Woo.
Yeah.
Yeah, well, uh, fasten your seatbelt and enjoy the ride if you can
Hmm.
tolerate it.
Yes.
So the red dots, so this is a calendar year chart since 1980,
45 years.
showing you the
Mhm.
red dots where the market traveled to down during the year
Yes.
and where it ended, gray bar, at the end of the year.
Correct.
Okay.
Yeah.
I see some consistency, Julina, and it looks like it often ends up positive, gray bar above the line.
Relative to where it fell at its worst.
But during every single year,
Hmm.
it turns negative.
I can also guarantee every year there is a market drop.
What?
Yeah.
So yes. So where the market travels during the year and where
Mhm.
it ends up uh,
Are different.
are very different. You can see it on this chart.
Yeah.
We think that
Because there's a red dot every year. However, the gray bars, 75% of the time, the market ends positive.
yep,
Okay. Thank you
yep.
for
And there's another data point on this chart that the average inter-year drop of 14.1%.
14.
14.1 is the average
Average
drop.
drop.
Yeah. Now
Here.
keep in mind it is consistently inconsistent.
Mhm. Yeah.
I wish we received it every year.
Hmm.
This way you build the tolerance for it.
Correct.
But we don't get it every year.
Yeah.
We'll get 6, we'll get 5, and then you'll get 18.
Yes.
And then you'll get 4, and then you get 18.
You can forget how it feels.
Exactly. So the sequencing and the cadence of it is
Mhm.
inconsistent. But when you average it out, yeah,
Yes.
the average decline is 14.1%.
Yeah.
Yeah. So it's, we're not there yet.
No. And this next slide is just as important because most investors are balanced between stocks and bonds.
Oh, the places you really won't go.
Yeah.
Yeah, if you're a diversified investor, that ride won't be as wild.
Correct.
It is a much tighter band of where you'll go.
Hmm.
And you'll have to squint to see this one, but the 60-40 return is expressed as a green diamond.
Yes.
And look, it's less fun to the upside,
Hmm.
but there's not a lot of
Not as
downside.
much the down. Yeah.
Yeah.
Hmm.
Yeah. So, and now this is a longer chart. This goes back to 1950, just to
Hmm.
show you the uh, incredible consistency to this chart. So if you're diversified, what you think you're doing, what's happening in your portfolio versus what you see on TV are two wildly different things.
Yes. Yep.
Yeah.
I think it's a great point. And I'm hoping that if anyone remembers anything from this webinar today, it's this one point. That's just my personal opinion. But it's just talking about the fact that the best opportunities in the market occur when you least expect them.
So, fact, the best days occur
Mhm.
after the worst days in the market, right?
50% of the time, they occur in a bear market.
50% of the time, the best days happen in a bear market. We're not in a bear market.
No,
28% of the time, the best days land in the first 2 months of a bull
the
market.
very
The
beginning of a bull market when
Yeah,
no one
which
even knows we're in it.
right, which feels like this. There's no way we're in a bull
Yes,
market. It hasn't even been called yet, right?
exactly.
Because we have to clear certain numbers. We have to rise above a certain level.
Mhm.
But that doesn't mean it's not the first 2 months of a bull market. So that's in the past.
Mhm.
Where we live right now,
Yes,
we're in the during the rest of a bull market period.
yes.
So only 22% of the time do the best days fall in what we have now, the third year of a bull market. Right. So when you have the opportunity to invest in one,
Mhm.
you invest in one.
This is the reason long-term investing works.
Yes.
Another way to show it, just to hammer it maybe a little bit further, right? is going back over the last 30 years. You look at if you were fully invested, you would have returned about, call it 10% on the far left side.
Mhm.
So this is a 30-year period. If you take the 10 best days out of 30 years, your performance drops in half.
Yep. Simple as that.
10 days.
It's um, I know people think we're making it up. We're not.
It's not on here, but I will also tell you when you look at the 10 best days and when they occurred over the last 30 years, 7 of them were within 2 weeks of the worst. It goes
Absolutely.
like that.
Yep. That
Yep.
is the cadence of it. It is the truth. So you have to grin and bear it, right?
Yeah.
And there's a reward for grinning and bearing it, and it is your net worth rises, your portfolio does incredibly well.
Hmm.
It's just that you have to be exposed to the volatility. The reward for it is great returns over a very long period of time. That
Yes.
has never not been the case. So
Okay.
yeah.
Thank you. So it's all about tariffs, but we did talk about something in the last webinar called DeepSeek.
We did. What is DeepSeek? That is the Chinese artificial intelligence. Remember that the news was covering 24/7 for about 3 weeks. And then all of a sudden, it doesn't matter anymore. Well,
Yep.
it did matter because this market movement,
Hmm.
again, just about isolated to the technology
Back.
sector, started with China disclosing, hey, look at our AI.
Yep. In January.
Yeah, and lying about it, saying that it was made very inexpensively. We only had to hire a few people to do it, and we just poof created it. No, you didn't. You've been working on it for a long time.
Hmm.
You powered it by getting access to illegally chips that you weren't supposed to get from NVIDIA that were handed to you through Singapore. Fact, you of course have this propaganda filter, so you can't ask it things like, "Is Taiwan a country?" Right? So how effective is your artificial intelligence? We
Hmm.
wrote a piece called Artificial Intelligence,
Hmm.
and it did have some benefit. The benefit was they made it with a brain that can be modified over time. It will learn on the fly and adjust.
Yeah.
Yes. And it also is sort of open architecture or open network.
Yeah.
I won't go into the details of that, but yeah, it does have some redeeming quality. The fear was whenever there's new technology that came out of the blue, and it didn't come out of the blue, it's just nobody really cared when China leaked it out in December.
Yeah.
So they leaked it out again in January to say, hey, can you hear me? Hey, we're supposed to spoil the party for your tech companies, right? The perception of we have a good thing. So they shouted it out again in January. And finally, investors listened, or at least
Spot on.
institutions listened. Yeah.
Yep.
And that is what started to send the Mag 7 down or the technology sector down. The majority of this sell off was
Sure.
really
Yeah.
ignited or driven by this. It was the fear of, well, does that mean that companies will spend less on data storage and technology and
Yeah.
power and chips and all that stuff? No, it's actually going to mean that they spend more over time. Are you
Yeah.
kidding me?
Yeah.
When the market is digesting news like that, and then there's tariff news, it's, you know,
Compounds.
oh boy, piling on with the data. Yeah.
Yeah. Yeah.
But it is what it is. I think this is more sparked and to do with that information than it is tariffs, which again, my view, negotiating tool. Is it going to be a wonderful tactic or tool? I think it's horrible, but it is what it is, and we're going through the motions here. So,
Yeah. And
uh,
you had some great points in the beginning, but we also have a few slides to address it as well. But and we realize that no one can read a single thing on this page.
yeah, we tried to put a lot of data on a page, and again, we have a ounce of humor in our body. So tariffs, fine print, and we giggle because you're not going to be able to read this. But this is parts of the email that I wrote last night,
Hmm.
showing you that yes, there are tariffs, but items in the USMCA trade agreement will be exempt. And there are other exceptions and exemptions.
Hmm.
And this isn't to be confused with this, and it excludes this. And we have the option to say, well, if we don't have enough of this, because this is done under a national emergency order, then we can change our mind and remove the tariff at any given time. And we can put it back on whenever we want,
Yeah.
right?
Yes.
So I'm telling you the truth here. I am having a very difficult time truly understanding what has a tariff on it, right? Because there are so many exceptions and exemptions.
And to make it even more confusing, as you indicated before, but this is a great visual. If again, if you can read it, is looking at the country by country breakdown.
Yeah. So again, if you've been paying attention to this stuff, you saw this chart that the president was holding. He didn't have a stand for it, of course. He was holding it. But what you don't know is there are six more of these, right? Because there are, I believe, a total of 186 countries that we've assessed this tariff on. And there are many of these charts. We just show you two of them. We will certainly want to put the one that has China on it in front of you. And then
Hmm.
if you're Laos, which is on the right hand side, um, that I believe is the biggest tariff at just about 50%. So,
Hmm.
anyways,
Yeah.
when you do the math, again, I talked about this earlier, those tariff rates on the left hand side are wrong. Those aren't actually tariff rates. Well, what is it?
Hmm.
What is it? It's the trade deficit expressed as a percentage called a tariff. Oh, I see. Okay. So it's 50% of that. Yes, it's 50% of that
Yeah.
in
Hmm.
the yellow. So again, it's wildly confusing, and it is certainly again hard to execute and very likely, highly likely, a negotiating tool to get countries and leaders to the table to figure it out.
Yeah.
And you give them 7 days. I mean, if you're serious about it, don't give them any time.
Yeah. Hmm.
So more to come as time
Time for
goes
them to
on.
react.
Yeah,
And let's talk about this trade deficit concept.
yeah. When you look at the trade deficit by country, and certainly as a percentage of the US's trade deficit. Is this really about Bangladesh, who's not even on this chart, or is it only about China?
Hmm.
I think it's only about China, seeing that they are the lion's share of it.
Correct.
Number one. Number two, I also think that I know that if you call China out individually, if you single them out, they hate it. They
Mhm.
absolutely hate it, right?
Can't do it.
You just can't do it. I mean, look, you can, but you want if you want to negotiate with them, call them out as part of a group.
Hmm.
I think that's what this is all about. Calling out China as part of a group without singling them out,
Hmm.
because they are really the ones that move the needle when it comes to any of this stuff that we're talking about. Mexico to a degree, but they just laid down Germany, who's putting up a fight and stink right now, but they'll likely lay down Taiwan, who boldly and bravely, but accurately, we are calling a country. I'm sure that drives China wild. Um, I mean, they're our friends. So is
Yeah.
Japan. So is Korea. South Korea at least. So is Europe, so on and so forth. So I think this is a lot of kicking and screaming and a lot of throwing punches with the real intent of landing them on China.
Okay.
Now, we'll see if we're proven right, but I think if this is a strategy that is born out of facts and math, that ends up being the actual strategy that we are trying to really target China and modify our agreements with them.
Yeah.
Potentially modify agreements on behalf of others with China as well. But we'll
Okay.
we'll see how
Yep.
it goes.
See how it
Stay tuned
goes.
for more.
Yep.
All right, let's talk about some other fun.
Yeah.
Hey, the firefighters that are the Fed, who hates when we're in a recession,
Hmm.
whose like purpose is to keep us out of one, is out there playing card tricks with their data, right? So the Federal Reserve, who just a few weeks ago at their March meeting, there will be no April meeting. They don't meet 12 times a year, they meet 10 times a year. April is
Hmm.
a skip month. We hear them again in May,
Yes.
unless there's an emergency meeting where they have to come to the table.
Yep.
50-50 chance. They move the goalposts
Again.
again, and they do it in such a sleight of hand way, like a magician,
Hmm.
that they don't think anybody is noticing. We noticed. So, what did they do, and why do we view it this way? Well, number one, they changed their forecast from September to December, and then again from December to March.
Hmm.
What did they do? They said, well, we think growth is going to slow a little bit, Right. Well, you already said that.
Hmm.
It's like, yeah, but we just wanted to put the words out there to let you know that we're paying attention. Oh,
Yeah.
so did you make a major adjustment down in your GDP projection, the economic growth projection? No, we made a slight adjustment. It's
Hmm.
like, okay, so you barely moved it down. I can tell you it will very likely come in, our GDP growth will likely come in below their expectation. Stay with me on this one. We adjusted our unemployment forecast. You did? So
Hmm.
you've been paying attention to the um, layoffs, the
Yeah.
voluntary sign up for a package layoffs, which is most of it factually at this point. We think there will be others, but um, that will have an impact to unemployment. Right.
Hmm.
So you're proving us right. You agree with us, Fed? Yeah. They moved their forecast for unemployment up a little bit,
Hmm.
but but through my lens, not enough. They moved their forecast for they
Inflation.
barely moved their forecast for inflation. Now they're
Mhm.
jawboning a lot, saying, "Yes, I agree. This could be inflationary if it executes, at least in the short term." But no one
Correct.
asks, "Well, how inflationary?" The Fed is literally saying, by a rounding error,
Right.
we think inflation might rise in the short term by a very little bit.
Hmm.
Right? Everyone says has these talking points like we think inflation's going to rise. Oh my God, what's going to happen? Are we going to have 9% inflation like we had 3 years ago?
Large
No,
concern.
no.
Yeah.
We think this is the Fed speaking now, not me.
Yeah.
We think inflation is going to go from somewhere in the low twos to somewhere still within the twos.
Hmm. Right. And we
I
just
mean,
got back to the twos.
that's like the wind blowing 1 mile an hour,
Hmm.
right? So why make these adjustments?
Hmm.
Why? Because now the Fed can do more and justify it based on their goals. They
Correct.
just lowered the bar to be able to provide stimulus before everyone's eyes, and we caught it. And I'm
Hmm.
sure a few others caught it, but we caught it, and here it is.
Hmm.
The bar is now very low,
Yeah.
which will allow them to point to this data and say, look, we told you if inflation came in at 2.9 versus 2.7,
Hmm.
would consider doing things. We told you that if unemployment came in at 4.5, we're at 4.1 now,
Hmm.
right?
They can justify it.
They can justify it.
Hmm.
We told you that if GDP comes in at 1.6 versus 1.7, 1.6, okay. I don't think we're going to go into a recession, but I don't think, 1.7 is still really good.
Yes.
Their long run expectation is 1.8% growth. And by long run, they mean 10 years.
Correct.
So it's like, wait a second, you think we're going to come in a tenth of a percent below your long run
Difference.
average?
Hmm.
Absolutely not.
Yeah.
We might come in, at zero point 0.7. So all this means is the Fed now has a platform, rather than looking like fools, um, to do more, and they have a lot of slack now to cut rates. They have
Hmm.
a lot of slack to do something else that they actually pulled off and not many people paid attention to. I hope that's the next slide.
Yep. The Fed
And
speak.
it is. And these are their words, right? This is the statement that they put out. We just highlighted the change from the prior statement. What we're showing you here, again from March 19th, is they provided stimulus and people just don't pay attention to it.
Yeah.
What did they do? Well, that whole quantitative tightening bond buying program where they were letting their balance sheet roll off, which has contributed to higher long-term and intermediate-term rates in the treasury market.
Hmm.
Those things that mortgages are tied to and auto loans are tied to, and the reason why mortgage rates are so high and the reason why loans are so high.
Yeah.
Yeah, it's because the Fed let their balance sheet roll off.
Hmm.
They've been in essence, a net seller of treasury securities pushing rates up, right? Well, guess what they did? They just about stopped doing that.
Hmm. Not
Effective
rolling it
this
off
month,
anymore.
they announced it in March, but they said it's right there in front of you. Beginning in April, the committee will slow the pace of decline of its securities holdings, its balance sheet,
Hmm.
with a monthly redemption cap on various things, so on and so forth.
Yeah.
They just provided easing,
And it's a
right?
$20 billion difference
So, per month.
per month.
Yeah. That is easing. They are easing financial conditions. They are winding up. They're getting the lasso ready,
Okay.
right, to come in and do stuff.
Hmm.
This is how they do it.
Yes.
It is right there in front of you.
Yeah.
So the
Nope.
firefighters are coming to the rescue if there needs to be a rescue plan.
If there needs to be it.
Yeah.
Exactly. So, and when you look at the bond market, right, you can see the lower inflation that's being priced in.
Yeah. If you want to know where inflation's going, don't listen to people that are trying to articulate it in 10 seconds on TV. Even if there's 80% of them saying the same thing.
Mhm.
Actually, run if it's 80% of them saying the same thing. If you want to listen to anyone when it comes to this stuff, listen to the bond market.
Mhm.
This is the 5-year tip
The,
spread.
the tip spread. Yep.
Yeah. So long story short, this is the biggest market in the world, the bond market, betting on the direction of inflation. And
Inflation.
you could see which way this chart is moving.
Yeah.
And then it just took a big anchor down. Now,
Yeah.
for many reasons, it says, well, there'll be less growth. Yes. And well, the impact, if executed, of these tariffs, or what ends up being the negotiating of current tariffs,
Hmm.
will very likely lead to lower inflation. No kidding.
Hmm.
Here it
Yeah.
is.
Yeah.
So when people say this could be inflationary, it's like, sure, the data in the coming quarter or two could show that inflation isn't going down.
Hmm.
Um, it could also show that there's a small, very
Bump.
small temporary spike up, but the trend is going to be
Yeah.
down.
And we've
And the
seen that
bond market,
historically as well.
historically, if you want to see the longer run forecast for inflation and
Hmm.
something that actually matches the direction,
Right.
you look at the 3-year tip spread, the 5-year tip spread, the 10-year tip spread. This is just priced into the bond market, and I
Hmm.
can tell you the bond market is called the smart money for a reason. I have spent a lot of time in the bond market. I get it. This is wildly accurate.
Yeah. Absolutely. And let's talk about housing deflation.
Oh, another contributor to lower inflation
Hmm.
is, again, if you live in the Northeast, you are not going to believe what I'm saying.
Nope.
You are not going to believe it. Outside of the Northeast, there's tons of housing inventory.
Yeah.
Tons. Go. Maybe some of your kids live in Austin.
Hmm.
Um, right now, they are providing incentives and bonuses to rent
Hmm.
a place in Austin, the
Yeah.
once hot Austin market. And that is the case for other parts of the country. So housing, which depending on which measurement you use for inflation, is anywhere between 40 and 70% of the inflation number. It looks like housing prices are cooling off,
Hmm.
which means rental prices will be cooling off.
Yeah.
What else is going to help? Well, the 10-year treasury that was approaching 5% 90 days ago is now at 4%. Well, that's
Hmm.
the benchmark rate that mortgage lending is based off of.
Correct.
Well, mortgage rates have come down pretty quickly.
Hmm.
We're able to speak to banks and get rates in the 5-ish% range.
Yeah.
It's amazing how that changed from 8 just a few
Absolutely.
months ago.
Hmm.
Yeah, so there are deflationary forces finding their way in.
Yeah. And I think just to clarify this visual a little bit, if you can't really read it, but the red line is the share of homes that are sold below the original list price.
And
That
that
is,
line is moving up.
uh-huh. Yes,
And the
exactly.
blue line, share of homes sold above original list price, is going back to
Has-
its average level. It's
exactly.
declining.
Yeah.
And what you see here is a great trend. But again, if you are listening to this in the Northeast, certainly in Connecticut, homes are being sold either at ask or above because it's
Yes.
a very competitive market. There aren't a lot of homes up for sale yet. And look, I can provide some rationale there, and this is directionally accurate, not
Hmm.
exactly what it is. A few things. Home ownership, the percent of home ownership in the Northeast is wildly high. The average mortgage rate that people have in the Northeast is wildly low.
Hmm.
And you do things like raise your family here, and then you
Until
move away,
and then
right?
you until you don't.
Yeah. So you grow up in the Northeast and then you move away. Generally speaking, it's a very competitive housing market. There's not a
Yeah.
ton of inventory. Why? Because people are locked into low mortgages. Yeah,
Yeah.
the percent of people that have low mortgages in the Northeast is incredibly high.
Yeah. Yeah.
Soon, our housing environment is going to look like the rest of the country.
Hmm. Yeah. But
Coming
but for
soon.
right now, we look a little unique.
And those are either less inflationary or deflationary forces that will be blowing into the inflation data.
Yeah, it's so interesting.
Mhm.
And the way that the Fed measures inflation is this concept we've talked about called PCE.
Inflation measured by the Fed is it's a different calculation. It's PCE. It
Mhm.
is items that we consume, but not just the big ticket items or the brand names. It is the alternatives,
Yeah.
right?
Kirkland?
I always joke and say, right, it is instead of the Grey Goose vodka, it is the Kirkland brand, which technically I think is Grey Goose anyways, but just with a different label, and it's less
Mm-hmm.
money. So when you look at the consumption trends, there are the brand names and the alternatives. That is the one that the Fed likes because that is a better measure of what is actually going on. But you can see here, wow, inflation has fallen from the sky.
Mm-hmm.
Yeah, and the expectation, if there is a rise in inflation, is to go above the level that we're at slightly
Yeah.
and then to actually continue the downward arc.
Mm-hmm.
So I'm not so concerned about this. And
Yeah.
I'm just about convinced that the Fed will be talking more about this in the coming meetings.
Yeah. No, I agree because I will say this is the one point that the media really likes to focus on and create anxiety for investors
Of course.
is on this inflation topic. So I think that's great. I also think it's important to understand the data that you're looking at, and there's what's known as hard data versus soft data that have very different implications.
Yeah. So in the economy, there are polls, right? And the polls are constructed in a way where they focus on um, home building activity. They ask questions about policy, so they create a policy certainty or uncertainty index. They
Inventory.
inventory all that stuff, right?
Yep.
Exactly. Then there's stuff like let's just talk to the general consumer,
Mhm.
um, and
See
then
how they
there
feel.
exactly. Exactly. It is the soft data is more emotion.
It's
And because
emotion.
and
Yeah.
because it's emotion, and again, I think many of our listeners know this, because it's emotion and it's soft data, they tend to be contrarian indicators,
Mhm.
right?
We talked about that in the past a lot. Yeah.
Right.
Hmm.
And those contrarian indicators are showing negative. Well, if the contrarian indicators are negative,
That should be a
isn't that
positive thing
isn't
for
that a
us.
positive?
Yeah.
Uh, yeah, I mean, you do the math on that. The hard data, the stuff that actually matters, is not showing what you think it's showing.
Hmm.
It's showing that the economy is growing, wages are pretty stable,
Hmm.
um, retail sales are pretty good. Yeah, I mean, look, the backdrop of the capital markets in the economy hasn't really changed much. We have growing earnings, corporate earnings. We have incredibly strong corporate balance sheets. We have what could be the most amount of liquidity we've ever seen in history on the sidelines,
Yep.
just about $8 trillion of cash on the sidelines in a declining rate environment, mind you.
Hmm.
The Fed just provided quantitative tight quantitative easing in
Yeah.
essence is what they provided via changing the rules around quantitative tightening. That's easing. Manufacturing is up. Oof, unbelievable. Construction spending is happening, and GDP growth is there.
Yeah.
Right? Can this slow? Yes. Will it slow? Oh yeah. I'm
Slow is
I'm
okay.
I'm quite sure of it. But
Yeah.
again, sometimes you forget we're coming from a level of economic growth that was quite unique, heavily infused by all the government money that was handed out and all that stuff.
Mhm.
We haven't even burnt through that yet.
Yeah.
We're still riding that. But the direction of the economy is certainly slowing. That
Yeah.
doesn't mean recession. It just
No.
means we're going from above average economic growth down to average, and we might even fall slightly below average.
Yeah.
What is a recession? Well, a recession is negative
Hmm.
and consistent negative, consecutive negative economic growth. I just don't think we're going to get there. It's going
Yeah.
to take a lot to get there.
I think we've
So,
talked a lot about how economic cycles and economic bull market can last 10 to 12 years on average.
yeah,
And I think this sign here of stability allows us to extend that longer. I think
yeah,
that's a very good thing.
yeah,
We're just
Julian,
emotional.
I do have to talk about this one data point that people are fooled by all the time. And it is when you hear things like JP Morgan or Goldman Sachs or all these big investment banks have adjusted their forecast and increased the odds of a recession. From what? From
Absolutely.
from something
Yeah,
to 35 to 40%.
correct.
Well, where was it?
Right.
At zero? No.
No,
Do you know what zero actually is in the world of economics? There's always a
they'll never say
25
zero.
there's always a 25% chance of recession. Always.
Exactly.
That is like the known thing. So when you hear things like, well, they increase the odds of a recession, from what? From 25% to 35%.
35, maybe 40, but they're not saying we're going into a recession. They're saying it's a slight higher
But the
probability.
soundbite makes it
Absolutely.
sound like 0 to, 100%.
Yeah.
It's not. They adjusted their forecast. Just do something here. Be mindful that all these big banks have been saying we're going to go into a recession uh, just about every quarter for the last few years,
Yes. I,
right? And they all, towards the end of the year, say, oh, because we haven't gone there, we're changing our forecast.
right.
But a forecast is for the future, isn't it?
Yes.
It's like, no, we just don't want to look bad, and it's not what you said, it's how you end and all that stuff.
Yeah.
It's wild what's going on. So there's a lot of data that's confusing out there. Don't fool for these tactics.
Nope.
Don't fall for these tactics.
I think that that's a very important point. So thank you for saying that. And I think this is also interesting as we're talking about emotions, what the consumer inflation expectation is. It depends on who you ask.
Depends on who you ask. Yeah. So when you look at consumer sentiment indicators and consumer inflation expectations, usually it's just presented or talked about as an aggregate index. Doesn't matter who answered the question, so on and so forth. Uh, well, I look. I love data like anybody else, but I like to look well within the data to formulate my own opinion and to really get granular to see what's going on beneath the surface. And when you look at the soft data and you break it down into who is answering these surveys and how they answer, oh, there's a big difference. So
Yeah.
when you ask consumers about inflation expectations, there is a grand canyon between the expectations of Democrats and Republicans.
Yeah.
The gap is so wide,
Yeah.
right? So be mindful of that. There's a lot of emotion in these answers.
Sure.
Okay.
Absolutely.
We can show you another one. That's consumer inflation expectations. This one is just consumer confidence.
Confidence.
It is just about the same spread.
Hmm.
It depends on who you ask,
Exactly.
right? So don't get tripped up with these stupid headlines about, this index says, that index says. It's also a lot of it is lagging information,
Hmm.
the approval ratings and all that stuff. No one is liked as much as they claim. No one is hated as much as stated. The truth usually falls somewhere in between.
Yeah. And I think it's important to know that if you do have an extreme view, know that there's an equal number on the other side,
Fair
right?
statement, Julina.
Thank you. So we always end with an everything else and try to end on a positive note. And we have one slide that we wanted to share that I thought was interesting.
Yeah, and I can connect with this, right? Because
Hmm.
we meet with clients every day, and we talk to people every day, and we listen, right? That is, I think, one of the things that we're pretty good at. We listen and we pay attention to nuance and we pick up on lots of things. And when we're having conversations with people, as much as everyone likes to think that we are all so different with our views and opinions and beliefs and all that stuff, I can tell you that's a bunch of nonsense. There is alignment between parties and people, or at least the people that have the labels on them.
Hmm.
They're a member of this tribe or this team or whatever it might be. Everyone wants and seeks belonging, and everyone cares about family, and everyone is connected to relationships and cares about relationships. And these are things that people value, and personal growth and health and well-being and basic needs and employment security and religion, spirituality or possessions, stuff, financial security, loyalty, inner harmony, freedom of speech, all that fun stuff. Yeah, your phone and what you read on your phone and the alerts that you get on your phone and where they come from and your small circle of people and your study groups and focus groups, there's a lot more connective tissue
Mhm.
with um, that people have in common with other groups and opposing groups and so on and so forth. We just get stuck with these topical things all the time.
Yeah.
We're all so similar, we're all connected, and you have to remember that. Stop pointing fingers and throwing stones at people. Let our politicians do that for us. Um, be an adult and get along. And, it's okay to tell people, hey, just wake up. Come on. We're so aligned in so many ways because we really are. We have clients that lean left, right, in the middle, some other angles.
Yeah.
At the end of the day, they all care about the same stuff. There is consistency here. So we are much closer to one another than you think, even though the headlines and the titles and the breaking news may say otherwise. And the news stations, depending on the one you flip to, may say something different. There's a lot more alignment than you think. And just remember that.
Yeah. I think that's a great way to end. And maybe also to end with what your original comment was we have great clients. We appreciate the relationship we have with the clients, and hopefully they've been listening to us, to your point about not receiving as many calls as maybe they think we're getting. So
Yeah. Yeah. It's remember to live in the wonder state, not the worry state.
yeah,
And if you feel like you're drifting over to the worry state, pick up the phone and call us. No
yes,
one's calling us.
yeah,
No one's calling us. Actually, that's too generic. Yes, there's a very small group of people that are calling us.
yes,
You tend to be the contrarian indicator for us. If we don't get those phone calls from you, we won't buy securities. Thank you for calling us. Now it is time to buy. I'm joking, of course, but you see what I'm saying. If you feel like you're in the wonder state and you're not getting information and you're getting emotional, you got to call us.
please call.
And keep in mind, chances are we're calling you, and that is our job to keep you informed, to meet with you, to talk to you, to articulate your strategy, to remind you that you're as wealthy as you were a quarter ago, in some cases 2 quarters ago,
Mhm.
and in some cases you might get it might move back a little bit to the spring and summer of last year, but it's not going to be much more than that. And then before you know it, you'll be at your new level of all-time wealth again.
Yeah,
So that's just the way it works, and you do have to remember that. And if you've worked with us for a long time, and 80% of our clients have worked with us for greater than 10 years, greater than 15 years, greater than 20 years. For our newer clients, welcome to the party. We're going to take very good care of you. And again, for any of you, if you have friends and family members that aren't being well cared for, we will take very good care of them. We are always open for business. We appreciate all your referrals. That is how we grow. We don't really do any advertising. So if you need help, feel free to reach out. If friends and family need help, or business partners, or whoever it is needs help, we can help them too. We appreciate you as clients. But this is our time to do what's right for you and to fulfill our fiduciary duty. And you bet we are going to do it like we always have. But now we get to do it with a bigger team. We're very excited to do it. So stay
absolutely.
tuned.
Stay
Stay
tuned.
tuned.
And thanks again, Bob, for all your insights. And we look forward to another webinar next month.
You got it, and see you next month.